Jai Hind to all and welcome to this session of export import documentation. All the contents are related to unit number 1 and in this video session I am going to cover introduction and registration process. Before going to the introduction or registration process, we have to know that what is export and what is import. Export means selling the home country's goods and services in a foreign country. That means when we normally think about export, we generally think about the products. But export of services are also there. Like export of IT services, lots of softwares are exported from our country to the foreign country. If goods are made in India and sold in France, then these goods are exported to France and then sales is done. Imports are just opposite to the export. In export, we are sending goods out of India, but in case of import, we are buying the goods from the foreign country and then bring it in our country. That is imports. In India, the highest quantity of the import is crude oil. Crude oil is the highest imported commodity in our country. Exports and import are both are the part of international trade between two nations. The following two conditions are the acid test for an export transaction. Then when I mean to say that when I can say the transaction is export transaction or international transaction, and to check this whether it is export or not, we have acid test, and this acid test contains two conditions. Condition number 1 says that goods and services must be sent across the national border to another country. That means crossing of the national border is compulsory. Second is payment of goods or services so dispatched must be realized in the exporter's country. And this payment must be realized within the specified time period also. Okay, so after satisfying these two conditions, any transaction can be known as export or domestic transaction, that we can classify it easily. Now, what are the implications for the home country? Implication related to export and implication related to import, both. In case of import, the benefits are too many, so much. First is the foreign exchange earning. Why every country is enforcing, or not enforcing, basically they are promoting the exports, because exports will earn lots of foreign currency, foreign exchange for them. And every country have their foreign exchange reserve, and they are trying that reserve should be increased, should be bigger and bigger. That is necessary for their, you can say that is a backbone, right, for every country. If their foreign exchange reserves are high, then it shows somewhat, you can say, stability or prosperity for the country. So by exporting the goods and services from the country, it will increase foreign exchange because it is an inflow foreign exchange, and every country is promoting now for better profits inputs. When the product is selling in the domestic country, domestic area, it may be possible then profitability may not be so high. But by exploring any foreign country, foreign market, you can earn better profits on the normal product, or by changing the product somewhat, you can do so. Improved quality. Improved quality means when the product is imported, obviously you have to follow the quality measures, the quality checks of that particular country. And if you want to face the competition in a foreign country, there are much more competition, because every country is doing export, they are promoting export, so that you have to maintain high level of quality to sustain in the foreign country. Access to new market, obviously this is again a benefit, that you are exploring new market, new places for your commodities, for your product, for your services, and new market will give you lots of benefits, lots of benefits in terms of foreign exchange, in terms of increase in sale, increase in profit, that will you can incur. Capacity utilization. What is that capacity utilization? Sometimes you have production capacity and full capacity is not utilized in the domestic market, the home country, because that can be because of low sales demand, right? The capacity may be unutilized. So for that purpose, if you have ideal capacity with you, then you can explore foreign market, right? With the improved quality, with the better quality, you can export your product and earn lots of revenues for your company. On the other hand, what are the implications for the import? Obviously, import is just opposite to the export. So there will be a foreign exchange outlay. That means in case of import, you have to pay foreign exchange to the foreign country, to the foreign company, and there will be cash outflow, foreign exchange outflow. Ensure availability of scarce unavailable. It means if there is any raw material or any input which is not available in the domestic country, import will be the best option. It may be possible that a material or input, right, for the service may be costly in your own country and available in any foreign country at a much lower cost, then imports will be very good. You can use imported product and save lots of cost. For technical know-how, obviously, if the technology of the any foreign country is better than ours, then obviously you can import the technology, you can use foreign countries technology that may be available at the lower cost, and it will increase your profitability. Add to export, it sometimes there may be situation that for export of your product you need some imported product, imported raw material, imported accessories, imported goods, consumable maybe. In that situation, import is necessary for export because you need some imported raw material for the production, for manufacturing, and without that you cannot produce your product and you cannot export it. So that can be a help, that can be necessary for the export. Better relations means, okay, in case of import, when you do import and export with a particular country or particular company, the relationship, business relationship will be very good, very improved, and that will give, you can say, long-term survival, long-term benefit for the company. Now, what is merchant exporter and manufacturing exporter? All the exporters can be divided, can be classified into two, that is merchant exporter and manufacturing exporter. As the name suggests, the manufacturing exporter will be the person who is producing, who is manufacturing the product himself and then export it to the foreign country. Merchant exporter will be the person who will buy the ready-made product, ready-made services, right, from the third party, from the domestic company, and then it may be possible that they change their packing, they put their brand name, and then it will be exported to the any foreign country. That means he is not actually the manufacturer of the product. Manufacturer will be somebody else, but he is doing trading activity, buying final product, ready to export product, and then send it on the on their own name under their banner. Merchant exporter and manufacturer exporter. Now, what is the regulatory framework, regulations which are required for export import in India? In every country, there is a regulatory legal framework for international trade. So we do also have same type of framework in India also. So in India, all the foreign trade, international trade will be governed by Ministry of Commerce, right? Through DGFT. DGFT means Director General of Foreign Trade. This is the basic governing body, highest governing body, issuing different type of official gazettes, notification on the export import, and all the exporters and importers have to follow these regulations. DGFT is coming under Ministry of Commerce, and they are Ministry of Commerce is there for announcement of the foreign trade policy from time to time. Normally, foreign trade policy for in India is a 5-year plan, 5-year policy, and currently FTP, Foreign Trade Policy 2015-20 is in force. And after 2020 and maybe in 2021, new foreign policy will come in force and different amendments will be there. The policy serves as basic guidelines for all the international trade transaction in India. Besides these, that means DGFT regulations and FTP, there are certain other acts which are which may have bearing on the international transaction. These are like Foreign Exchange Management Act, better known as FEMA. FEMA 1999 is the year of incorporation of the act. The act aims to regulate and manage foreign exchange transactions through RBI. As per Act, except the general and specific permission of RBI, no person can deal in or transfer any foreign exchange or foreign security to any person who is not authorized to do so. It means that all the movement, all the flow of foreign exchange will be handled, will be regulated by FEMA. All the provisions of FEMA will be applicable on international transactions where there is a movement of cash flow, either inflow or outflow. There are authorized dealers who are dealing with these foreign exchange. So any person who is not authorized dealer is not allowed to deal in the foreign exchange. And no person can make a payment to or for credit of any person residing outside India in any manner, receive otherwise through an authorized person any payment by order or on behalf of any person residing outside India in any manner. That means all these are the example, few example which is given under FEMA Act. There are so many other conditions which are covered in the FEMA. That means if you are doing international trade, export, import, then you have to refer different provisions related to your situation in the FEMA Act. That is applicable on all. Next act which is applicable is Custom Act 1962. Custom Act provide for different information related to levy and collection of custom duty, prescribe the procedure for import export. The objective of the act is like to promote the export import in India, to regulate, to avoid the illegal things, to put a restriction on the illegal things. All the provisions are related to the movement of goods are given in the Customs Act 1962. The Act uses custom law and levy of custom duty as means to achieve the following: restricting import for conserving foreign exchange. When a country thinks so that there are so much of import and high level of import is damaging the domestic country, domestic industry, then they may impose different restrictions on the imports. Protecting Indian industry from undue competition may be possible, that the businessman is importing the material at very low cost, and it creates lots of huge damage to the Indian industry because there is severe competition, cutthroat competition we are facing. So the impact is very negative, very damaging. In that situation, they can impose different duties like anti-dumping duty, safeguard duty. They can impose different duties to save the domestic industry. Prohibiting import export of goods for achieving policy objective of the government. Regulating export to avoid smuggling, obviously, to make the negative list of the goods and product and services like which are coming under the Smuggling Act. Okay, coordinating legal provision with the other laws dealing with the foreign exchange, such as Foreign Trade Development and Regulation Act, Foreign Exchange Regulation Act, Conservation of Foreign Exchange and Prevention of Smuggling Act, etc. These are the part of Custom Act. In addition to the Custom Act 1962, there is Custom Tariff Act. Custom Tariff Act is basically dealing with the HSN code and the rate of duties. Thus, prescribe the rate of duties of rate of duty related to custom on import and export of various goods. That means if you are in export import business, you have to refer Custom Tariff Act to see the codification of your particular product and rate of duty imposed, applied on your product. Now, what about quality and inspection? Obviously, in international business, international trade, quality matters a lot. If you are sending quality product, then only you will be surviving in the international trade. Otherwise, the competition level is very high. Somebody else from some country will come and your sales level will be down. Your product will be rejected because that can be on the quality issues. So, for ensuring the good quality product and services for export, we have the Act And the name of act is the Export Quality Control and Inspection Act 1963. This act amended is 1984. Huge amendment, proper amendment was there in the year 1984. Was it established by Government of India to ensure sound development of India's export trade through good quality and inspection and for matter connected thereof. Export Inspection Council. A proper council was established under this act, Export Quality Control and Inspection Act. This council was established, created or set up by Government of India, and the duty of the council members, that means the prime responsibility of the council, is to check the quality, okay, to ensure the quality and to prepare the procedure of inspection, to prepare a list of the product for which the pre-shipment or post-shipment inspection is required. Okay. So notify that the empowered, that means the power of the EIC, Export Inspection Council, is to notify the commodity which will be subject to quality control and inspection prior to export. It is pre-shipment. Prior to export means pre-shipment export. Establish a standard for quality for such notified commodities. Specify the quality of product, the type of quality and the type of inspection required for the specified such commodities. Right? Beside the advisory role, EIA, that is Export Inspection Councils, EICs, are also exercise technical and administrative control over the 5 export inspection agencies. Right, and these inspection agencies are in Chennai, Delhi, Kochi, Kolkata and Mumbai, and they are established under Ministry of Commerce. So these inspection agencies are responsible for the checking, for ensuring the quality control, and they are coming under the flagship of Export Inspection Council. Now, how to start export-import business in India? What is the procedure, right? How a person can become an exporter? What are the basic formalities which a person should comply with? What are the registration process? We'll discuss that. So, to begin with, that means if you want to start export-import business in India, different type of registration under different act is required. Apart from this registrations, you need bank account, we need different codes, right? One by one we will discuss. First thing is registration of organization. That means to become an exporter, first you have to decide that what type of organization you are. You can be a company, you can be a partnership firm, you can be a sole proprietor, whatever it is, you have to register yourself as a business organization. It means if you are a company, private limited or public limited company, you have to register yourself under Companies Act 1956. Okay. If you are a partnership firm, then your registration will be under Indian Partnership Act 1932. After this registration, you need a bank account. Obviously, a current account is required. Saving account is not there. Current account is required for business, for export-import. Bank account will be in name of the company or in the name of business, and this current account will be that is under, you can say, supervision of RBI. RBI will be issuing different circulars, different notifications which are dealing with the foreign currency, then you have to comply with. All financial transactions of the exporter organization are routed through this account only. Such bank also serve as a source of pre-shipment and post-shipment finance for the exporter. That means if you want loan for the production, pre-shipment or post-shipment, loan is required, bill discount is required, or other banking facility you want, then in that case you must have proper operated current account with any bank. Next is you need IEC code. IC means importer exporter code. IC number will be given by DGFT. That means you have to apply on the website www.dgft.org. Online application will be there, and you cannot start your export-import business without IC number. IC number is mandatory, compulsory. Okay. Application fee for the IC application that will be rupees 100 along with the papers that the name of the business and the proof of the registration, right? There are so much of paper required, and along with these papers, if you apply online, then you will get approximately 20 to 20 within 15 to 20 days your IC code from DGFT website. Along with this IC number, you need PAN number. These can be parallel activity. That means if you start your own export-import business, parallelly you can apply for your input, that is PAN number or IC code and GST number. Parallelly, this can be done. So, for international trade, you must have a valid PAN number. PAN number will be issued from the Income Tax Department after filing form number 49 along with the prescribed fee. Okay, so that is required. PAN number is also required for claiming export exemptions, deductions. There are so many export promotion scheme for the exporter. If you want to claim the benefit of this scheme, then you must have a PAN number. PAN number means permanent account number given by income tax authorities. You are required to register yourself under GST, goods and service tax, that is indirect tax. Okay, without this you cannot start your business, like international business as well as domestic business. Goods manufactured for the export purpose as well as purchased from the local market for export purpose are completely exempted from this GST. Okay, and to claim the exemption, if you want to get it reimbursed, if it is already paid, then you must have GST registration. Okay, GST registration is required to be completed by every exporter with effect from appointed date fixed by Government of India by 2017. Then registration with Export Promotion Council, very important, and even that is compulsory, that is mandatory, that is required to start a proper business, right? Export Promotion Councils are the, you can say, non-profit making organization under Government of India. They are built, they are established for export promotion of particular product. That means for specific products, like we have agriculture product, we have different export promotion council. For capital goods we have different, then we have tea board, rubber board, coffee boards, right? So we have in India so many export promotion councils and boards to promote the export. These councils are different for different product. That means you have to check, you have to see that what type of your product is, and then what is the export promotion, what is the name of export promotion council applicable on your product. After applying to EPC, the exporter will get RCMC. RCMC means registration cum membership certificate. This certificate will be given by EPC after completing all the formalities. At present, there are 31 EPC and boards dealing with the various commodities. The benefit extended to the exporter under new foreign trade policy. Basically, this is the older one. Presently, foreign trade policy 2015-20 is in force. Are extended. That means if you want to take the benefit of export policy, foreign trade policy, then you must be registered with EPC and you must have a valid RCMC certificate. Registration with ECGC. ECGC stands for Export Credit and Guarantee Corporation of India. Exporters are exposed to commercial as well as political risk in the international market. Therefore, in order to get protected themselves against this type of risk, that risk can be your fluctuation, currency fluctuation risk, political risk, environmental risk. There are so many related to international trade. It is necessary to get the registration with the ECGC and make yourself secure. ECGC also help exporter in obtaining financial assistance from the commercial bank or other financial institution. If you want loan, financial assistance, then ECGC will be very helpful. This registration, they have advisory body, they have credit, you can say rating for the different countries and buyers. So these informations are very helpful for the exporters. Now few detail about export import code. Export import code, that is IEC code, is basically PAN based code. PAN based means PAN number along with few other details, few codes will be added for the details. IC code is unique 10-digit code issued by DGFT, Ministry of Commerce, Government of India, to the Indian companies or all the exporters. IC code is import export code and the application will be on the website of DGFT. Okay. No person or entity shall make any import export without IC number. That means to start export import business, you have to apply with the IC number. Without that, you cannot start. Okay. One very important thing is that because it is PAN based, that means for one PAN number, only one IC code will be there. Okay. You cannot apply for multiple IC number. It is not valid. And Ayat Niryat form ANF 2A will be filed for the application as an application of IC number. IC number will be valid till the closure of the business. That means once it is allotted, it will be allotted for the whole life of the company. IC number allotted to the applicant shall be valid for all the branches, divisions, unit, factories as indicated in the format of IC given in the appendix 18B. As I have already told you that it is a PAN based number, that means on single PAN, single IC code will be there and applicable on all the factories, division, units of the company. If you missed the IC number, misplaced the certificate, then you can apply for duplicate copy, and duplicate IC number, duplicate certificate will be given by issuing authority after giving an affidavit for missing, right, and for after paying the specified fees. If you want to stop your export import activity, then you have to surrender your IC number. If an IC number holder do not wish to operate the allotted IC number, he may surrender the same by informing the issuing authority. That means you have to inform DGFT on a specified prescribed format that you want to surrender your number, and then it will be cancelled. That's all for the first lecture of export import documentation. Thank you so much.